Good afternoon. So today I'm going to talk about how to make $1,000 a month passively, pretty much in your sleep using a diversified portfolio that's pretty safe. So if you're interested in how to make $1,000 a month, stick around for this video and we'll get into that. Good afternoon. My name is Adam Kahn and I'm the Rational Investor. Today is Tuesday, November 28th. I hope you're all doing well. Today I'm going to talk about how to make $1,000 a month doing pretty much nothing other than collecting dividend checks. So I hope you find that interesting. Before I get into the details of the video, if you haven't already, do me a favor, uh, hit that subscribe button, smash the like button. By all means, make some comments. I really like the conversation. I try to answer everybody and I try to do it in a timely fashion. If you guys have things you're interested in or ones you want me to look at as well, I really like this stuff, so I don't mind going into detail on some of it. I'm also going to put a couple links in the description on opening an account with SoFi. You can open a checking and savings. You can open a stock account. I use them myself. If you put in $10 or more, they're going to give you a free $25, and they're also going to send a gift to me. It's an account I open with my son. He's 13 years old. I try to teach him about investing as well. I do a lot of real estate and I do a lot of stocks, so that's primarily what I talk about if you guys haven't been watching. But it gets him really excited. It gives me an excuse to get into it somewhat, even though I talk to him all the time. I don't know if he always listens, but I still like to talk about it. I'm going to give you a general real quick that I'm pretty bullish the markets. That's both stocks and real estate. I have my reasons on both if people want to understand why, because I know real estate seems like it's gotten expensive and there are a lot of people out there that are real gloom and doom. I just don't see it the same way, and I've gotten some pushback on some of the comments I've made. Just to give a little background, I've been in the market since, geez, I graduated in 94, so I started getting invested in around 95, 96. I then made my way to Chicago, where I was a professional trader on the floor of the exchange out there, where I traded currency futures for a long time. Um, I was really fortunate really quickly and lucky. And then when computers came around and the business kind of changed, I moved out to Vegas, where I started investing in real estate and using the income I would receive from the rental properties. Pretty much when in 2008, I picked up a few items when the market corrected. Um, and I've been really fortunate with it. Now, I've watched the market since 1995. I keep an eye on everything. I find it interesting, but I generally use a combination of charting as well as just my own thought process as to what's going on in the world. So I may not point to a specific thing, but I've been pretty fortunate and pretty lucky with the decisions I've made. So today I'm going to talk about a portfolio that combines what I think are some growth stocks along with they all pay some dividends. And if you invest in these in the amounts that I tell you, you should get about $1,000 a month on average coming in without doing very much. And in my opinion, it's a pretty safe portfolio because I've spread out pretty well. But you guys really have to do the research yourself. You can't rely on me or, for that matter, anyone else on YouTube. You really have to look into these things and decide what makes sense for you. Not only because that's the right thing to do and you can't trust everybody else, but everybody's position is unique to their own situations. You know, my situation is going to be different than yours, so you have to do what makes sense for you and the situation that you're in. On top of that, when I watch the videos, because I like watching the other guys too, I see some people with some great advice, but I've also seen some with some terrible advice and some things that they really don't understand exactly what they're investing in, and they don't understand the risks that they're taking on. That being said, they're giving advice to other people about getting into these funds that are quite risky. Um, so I worry about that in terms of I'd hate to see people overinvest in them. Now, they may work out great. I don't want to say they won't, but there's more risk in those portfolios than I think some of the people touting them realize. So I'm going to go through the stocks. I'm going to tell you how many shares of each. I'm going to break down um, the total at the end if you stick around, as well as what each one pays in dividends and everything else. But I'm going to go through real quickly about how many shares and the payouts first. So I'm going to rattle through the stocks that I picked in the portfolio first, and they're all going to have an even investment. And again, I'll get into the end what the total investment is. I'll talk about how many shares, what the dividends they're paying, and everything else. But right now, I'm just going to read through them. I have Best Buy, Altria Group, um, Stanley Black& Decker, Caterpillar, Citigroup, Bristol Myers, Pfizer, Target, a stock that's called Vertis Infracap, which is a preferred stock ETF. Ticker symbol is PFFA, and it's just one that I tend to gravitate towards. Starbucks, Foot Locker, Chevron, Kinder Morgan, Cisco, RTX, which is formerly Raytheon. They changed the ticker and the name to RTX Group. Starwood Group, and Coca-Cola. So hopefully what you see is I've tried to hit different sectors and a combination of growth stocks that pay a dividend, as well as a few higher paying dividend stocks and ETFs to help supplement it to push up the rates a little bit higher. I think I've spread out pretty well to where no matter what's going on in the markets, you should be diversified enough that you don't get crushed. Maybe somewhere someone has to cut their dividend or lower it, because if you don't know, dividends are not guaranteed. Companies hope to grow them over time, but sometimes they have to cut them completely. Sometimes they have to lower them. It just depends on what's going on with the company. So you don't want to be like, I'm a dividend junkie and I get a little over attracted to it. But the reality is you want to be careful because the companies have to make enough money to be able to pay those dividends. So with the amount of shares I was using in the portfolio, it has a total income in dividends over the year of a little over $13,000 a year. And now I'll break down how many shares of each company you'll buy, and then we'll get into the total investment of the total fund. So Best Buy, you'd need to buy 210 shares. Altria would be 355 shares, 165 shares of Stanley Black& Decker. I'll give you the ticker symbols of all of them as well. 60 shares of Caterpillar, 330 of Citigroup, 305 Bristol Myers, 505 of Pfizer, 114 Target, 785 of Vertas Infracat, 145 Starbucks, 630 of Foot Locker, 103 Chevron, 870 Kinder Morgan, 300 Cisco Systems, 185 of RTX, 760 of Starwood, and 255 of Coca-Cola. Now, what it breaks down to on each individual stock. So Best Buy closed at $71 a share today. The 210 shares, they pay 92 cents a quarter. It averages about 5% yield, which is $781.20 a year if you multiply the quarterly dividends out. Altria Group pays a 98-cent quarterly dividend. They closed today around $41.82. The 355 shares pays about $1,391. It's a little over 9.25% return. It's one of the ones that pays a little bit higher of a dividend. It's not one that I feel like, it's not an ETF. The risk of Altria Group is, since they sell cigarettes, of one day having a lawsuit about the cigarettes and that impacting the ability to continue to grow and stuff like that. I think that's part of why they pay out such a high dividend. I think they don't want to keep too much cash in the company in case that lawsuit comes around in the future. I have no idea. That's just a guess. By all means, like I say all the time, do your own research on that. That's just my own hypothesis. Now, Stanley Black& Decker closed at $90.50. They're paying an 81-cent quarterly dividend. 165 shares, it comes out to $534.60 for the year, so long as they can continue to pay that dividend. Caterpillar closed at 247.75. The 60 shares, they're giving $1.30 as their quarterly dividend. It's about a 2% dividend yield. I just like Caterpillar. I think they're in a good space. I think it's a good investment. Pays only $312 a year, but I think you have growth potential with Caterpillar. And I think it's really hard for another company to come around and compete with them, because the cost of entry into that would be pretty exorbitant. And I don't know too many places that are just going to come around and start building bulldozers and stuff to compete with them. Um, Citigroup closed at 44.85, and these are all approximations. It pays 53 cents a quarter. It's about 4.7% yield. The 330 shares should pay $699.60 over the year. When we get to Bristol Myers, they closed at 48.90. It's a 57-cent quarterly dividend. The 305 shares comes out to 695.40. I like Bristol Myers. I like the drug space. I think these companies, they're really out of favor. Both them and the next one, Pfizer, that I'm going to get into, they're at their lows. I think they could struggle for a couple of years even, but I think they should be able to pay out those dividends. And in time, whatever's going on, I don't know if it's because of a new law that they're looking at that might try to make medicine more affordable. I don't know if it's going to squeeze them on what they can charge. But I also find in the long run, those things usually work out for the companies and they generally end up pretty profitable. And either the government subsidizes it or they find some solution. So the one I already mentioned, Pfizer, it closed at 29.70. They're paying a 41-cent dividend. The 505 shares are approximately 5.4, 5.5% yield, and it pays $828 for the year when you multiply that out. So Target closed around 130, 150. You guys know who's been watching. That was one of my favorites. Dropped down to 106, 107. I still think it's a buy up here at 130, which is where I started buying on the way down when it got down to 107, 106, and I was picking up more. They're paying a $1.10 quarterly dividend right now. It's about 3.35%. The 114 shares that I used comes out to a little over $500 for the year. Virtus Infracap, the 785, their ticker symbol is PFFA. It closed at $19.05. They pay out monthly, not quarterly, and it's a 16.5-cent dividend each month. It's a little over 10%, 10.4 based on what I saw on my E-Trade account, and it's paying $15.54 a year, which I did that to help boost that return a bit in terms of the dividends. And since it's preferred stock, it's a little bit different than most of the things I invest in. It's not real estate, it's not some of the other stuff. I think it diversifies me a little. And I just hope that the managers are picking some good preferred stock. Starbucks, which is one of my favorites, closed at 101.20. They're paying a 57-cent dividend. The yield, kind of like Caterpillar, is a little bit low at 2.23, but they tend to raise their dividend at a pretty good rate. And I think the company has growth potential. I think over the next 5, 10 years, I'd like to see Starbucks double, triple, quadruple. I love Starbucks. Now, you guys have to do your own research. Maybe it's not a company for you. It's just one of the ones I like. 148 shares is about $337 when I multiply it out over a year. The next one I have on my list is Foot Locker, which closed at 23.70. They have their earnings coming up in a couple days. I just know that because it's one of the holdings I've had for the past year. I plan to hold it for a while because I like the new CEO they brought in. She helped grow Ulta Beauty significantly when she worked there, and then she wanted to go to Foot Locker, from what I understand. Um, Currently, they're paying a 40-cent dividend, which is a little over 6.5% return. 630 shares comes out to a little over $1,000 for the year. I hope that dividend is secure. I don't really know. According to what I've seen, the earnings are just fine to support it, but that doesn't mean that they may make some changes or that it may struggle for a bit. But I think it's okay and it's great return. So as long as they're able to pay that dividend, I'm comfortable with that. And if not, so I'll figure it out from there. Chevron closed at 145.50. They pay $1.51 quarterly dividends, about 4% yield. 103 shares comes out to $622 for a year. Next, I have Kinder Morgan. Their stock tends to go nowhere, but they do pay about a 6.5% yield, which isn't so bad. Um, 870 shares, they're paying 28 cents a quarter. Comes out to $974 for a year. Um, I don't really think Kinder Morgan is going anywhere. They actually just went into contract with NextEra Energy Partners to buy up a bunch of pipelines that they own. So I assume if they're expanding, that means they're doing okay. Cisco Systems, not the food company, which is a good company as well, but I went with the tech company. What I like about them is they had earnings that weren't so wonderful, and the stock price went down. So you can get a few more shares for the same amount of investment. Close today at 47.85, paying a 39-cent quarterly dividend, it's around 3.25% return. Comes out to about $468 for the year if you have 300 shares. Um, RTX is the next one I had on my list. Closed at $80. They're paying a 59-cent quarterly dividend, 3% yield, 185 shares, be about 436.60 if you for a year, assuming that dividend stays stable. Next one is Starwood, which is the hotel chain. Now it is run as a REIT. Since I'm in real estate as well, I try to be careful and I don't have too much of it. But if you're not, it does give you some exposure to the real estate market. It closed at $19.75, 48-cent quarterly dividends, paying a 9.5% yield. Keep in mind that that one legitimately could change from quarter to quarter based on how REITs work. But based on where it is now, it's a 760 shares, be about 1450 for the year. And last on the list is Coke, ticker symbol KO, closed at $58.65, pays a 46-cent quarterly dividends, about 3%, 3.15 yield, 255 shares is $469.20. Now, that's the whole portfolio. Pays a little over $13,000 a year, which comes out to $1,089 a month. I know this will be a big number, but that's a $250,000 total investment. But it's completely passive. You can really start really small and just start getting into some of these things and grow over time. I just see dividends as a nice way to be able to go to sleep and have some money coming in. And if I can make $1,000 a month, I can make it a goal to try to build a 250,000 over, maybe I can do that over 6 or 8 years. And if I invest in the dividend stocks and reinvest the dividends, whether it's in back into the same stocks or into some of the other ones to grow that portfolio, it's really nice to have that extra income coming in so that when Social Security and maybe your pension or whatever it is that you need for retirement starts kicking in, you have an additional income on top of it that, unlike real estate, isn't going to require you to go out and fix an air conditioner or find a new tenant when there's a rotation or the things that come along with that. So I hope you found it interesting. If you have any questions, by all means, reach out. Don't forget, if you haven't, subscribe, like. Hopefully, you made it this far. Send a shout out letting me know if you did. I think that'd be awesome. And have a great rest of your day.